Good Friday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you. TGIF. I'm going to give this one about 5 exclamation points. Hope you had a great Friday. Hope you're going to have an excellent weekend coming ahead of you. Flying solo this afternoon. Mr. Gunn has the afternoon off. I will grab the helm of the ship and drive this thing through some stormy waters. And boy, were they stormy waters today. Started off just like the last couple days. Dow coming down, NASDAQ coming down. But what made things different is we actually finished down well off the lows of the Dow. We were doing much better going into the close than we sold off in the last couple minutes. Finished down about 310 to be exact. But we eked out a very small gain of about 30 points on the NASDAQ. Okay. Now, why am I telling you this already? Because this ties into exactly what we're going to be discussing this Friday afternoon. You know, I'm going to take you back a little bit into some of the other things I've been talking about, Jason and I have been talking about. And I bet it's been probably about a month, if I remember correctly, where we brought up this term to you called circular accounting. Now, don't change the station on me here, okay? I'm not going to bore you with a bunch of accounting terminology. But it's very important because if you have money in the stock market, circular accounting may be impacting the performance of your 401k, your brokerage account, so on and so forth, because it's impacting the market. We've talked also a lot about a potential bubble forming. You know, not just us, but a lot of portfolio managers on Wall Street talking about bubbles forming due to the AI situation. Lofty levels, can they sustain the valuations that the stocks are trading at? All those normal things. We've also talked a lot about similarities of this market going back to the dot-com era of 99, 2000. A lot of differences, a lot of similarities. And so for the last few weeks, we've talked a lot about, again, is this different this time around? Well, once again, the comparison and the contrast of current times to years past, 99, 2000, can be quite vast or they can be very similar. Let's talk about some of the similar situations. You've got AI-driven stocks that seem to be able to do no wrong. You've got AI stocks that everybody from the institutional level all the way down to the retail side wants to own. You've got extreme optimism that, again, they can do no wrong, right? They're spending so much money, they've got to grow. You get my picture. You contrast that to stocks that have valuations that are in some cases in the stratosphere. You have huge sums of money, much greater than in the dot-com era. Huge sums of money, i.e. capital, being deployed into data centers, not only the physical construction of the data center, but also those GPUs, the chips, everything that goes inside the data center. You also have concerns about how is all this being paid for and who's paying for it. Folks, there's only a handful of people, meaning companies, that are paying for these data centers that we've seen spring up. You got Microsoft, you've got Google. Microsoft, Google, you've got Meta. Of course, you have NVIDIA, you've got Oracle. Those are your major players there. A little bit of Palantir. Those are the major players. But one thing they have in common, they're all tied together in some sense. And see, we've spent a lot of time talking about how NVIDIA kind of is buying business, right? Like the deals they struck with OpenAI. That's the other company, obviously, right in the center of this whole thing. So if you look at all those names I just mentioned, in the center is NVIDIA, right? They are the 10,000-pound gorilla producing the GPUs and the chips that are in the data centers. But what are they doing? As we heard many deals announced earlier this month, or actually last month. Hey, buy $100 billion worth of our chips, and we're not going to charge you right now, but you can pay us over time. He's doing that to companies like an OpenAI, not even a publicly traded company. Massive profits so far, but significant amount of debt they're taking on. So just to refresh your memory, that's what we've kind of dealt with up to this point. And it's, honestly, it's brought a lot of concern to me. My job and Jason's job as fiduciaries of our clients' money is to always be second guessing things, right? If something's going up, why? If something's going down, why? We have to understand that for our clients. And we do our very best to do that. And then we relay that over to you, our radio audience. So that brings us up to today's topic. And I've titled today's show, The Cheating Depreciation Schedule. Whoa. Cheating? Depreciation? What in the world's going on? Well, this is where I'm going to get a little bit heavy with you after I do my stock market recap. Because I'm going to take you into the world of accounting, right? Not so much circular. That's a whole nother issue. Circular accounting, again, where I have a product, I want you to buy it, you can't afford to buy it, so I'm going to give it to you, But in turn, you're going to do business with me. Not only are you going to pay me back for the product that I gave you, but you're going to do business with me. And therefore, we'll both make money. Is it legal? Yeah. Is it a little bit, pushing the envelope? Yeah. Does it give a representation of honest, accurate earnings? That's what's up for debate. But how about this thing called depreciation? You see, folks, if you never took an accounting class, I'll explain depreciation really, really easy. Most of you have bought a new car at some point. You've all heard the adage. Go to the new car lot, you buy a car for $50,000, and the minute you drive it off, it depreciates. It's worth, whatever, pick a number, 40,000, 45. Definitely going to be worth less than what you just paid for it 5 minutes ago. So depreciation is a schedule of an asset losing value over a specified period of time. And you see, the IRS assigns a depreciation schedule to different assets. But when it comes to GPUs and semiconductor chips and so on and so forth, it's kind of left up to the eyes of the beholder, meaning the company that bought those GPUs and the chips, etc. IRS really leaves it up to them to disclose how long they're going to depreciate those assets. Okay, now follow me so far. The company must then, if and when they get audited by the IRS, they must then justify to the IRS that they depreciated those aforementioned items over a specified period of time according to their use of the item. So the IRS may say, you got a 10-year depreciation schedule on a GPU. So GPU, again, if you're not familiar, it's just all of you have a computer. That's your CPU. GPU is this different version, higher end version, et cetera. Let's leave it at that. Okay. But it's up to the company that bought that GPU and those chips from NVIDIA and other manufacturers, Advanced Micro Devices, Intel, et cetera. It's up to the company that bought those to say, here's how long we think those chips are going to last in their useful life. So let's give you an example. Let's say I sell a chip to Sally, okay, Sally's company. Let's say I sell that chip for $1,000, okay? Sally then goes to her accountant or her accounting department and says, okay, we just paid Sanchez Electronics $1,000 for this chip. Put it in our books, right? That's an expense of the business. That reduces their income. So there's $1,000 I just spent on a chip. Now, I can turn to the IRS depreciation schedule table and go, a chip has a life expectancy of, again, whatever it is. Let's just say 6 years. But so what that means is that $1,000 that I just paid for that, chip. Let me bring up my calculator because my brain's pretty dead this time of the week. $1,000 divided by 6 years. So that means I would write off $166.67 of that $1,000 purchase every year for the next 6 years. After my 6 years are up, I fully depreciated that chip. And if it's still running, okay, cool. I get no tax benefits. Because you see, folks, as a business owner, one of your greatest things that you can do is have this thing called a phantom expense, depreciation. See, depreciation doesn't cost you anything. It's almost like the government paying you to buy something. Why do you think business owners towards the end of the year go out and start, a big contractor, they're going to go out and go buy a whole bunch of brand new trucks? They're going to pay the government, $1 million in income, or they're going to go spend $1 million on trucks. And I'll complicate it even further. You now can depreciate up to what we call a Section 179 expense. Take that about, 1.2, 1.3, right around there. You don't even have to depreciate it. You get to write it off the year you buy it. Even better. Let's say they wanted to depreciate it. So they take that, divide it by the depreciation schedule, and they get to write off that $1 million purchase. If it's 5 years, every, 1/5 every single year. So back to my chip example. Dolly bought my chip for $1,000. She goes to her accounting department, says, okay, we just bought this chip from Sanchez Electronics. Accountant goes, okay, cool. We're going to write this off. And again, let's just say it's a 6-year depreciation schedule. We're going to write off $166.67. And where I got that number, $1,000 divided by 6 years. So we're going to write off $166.67 every year. $166 reduces Sally's business income. Okay. It's a phantom expense. Now she bought the chips, but hopefully they're making her money, but the government's allowing her to basically write off that entire acquisition cost. Okay. Pretty simple so far. But where the waters get muddied is what I said a moment ago. The IRS pretty much allows these companies to determine, based upon the amount of use, how long that chip is going to last. You see, if John Doe's company is just a go-getter and that chip is, working 24 hours a day, 7 days a week, and Frank Doe's company, maybe they're an upstart, maybe they don't have a lot of activity going on, the chips aren't working that hard, who do you think's chip's going to last longer? Frank Doe's company. His chips are going to last longer. They're not being used as much. But if you take a company like a OpenAI, a Microsoft, a Google, an Amazon, so on and so forth, those chips are running hard every single day. Which one do you think is going to last longer? Frank Doe's chips, right? So should he have the same depreciation schedule as the other guy? That's up to the company. Well, the point I'm getting to with all this, now that you understand basically how depreciation works, now what I'm getting to is the following. If I am able to, I'm just going to pick a company. I'm not saying they're involved, they're doing this. I'm just going to pick a company. Let's say that I'm Microsoft. If I'm able to depreciate that chip that I just bought for $1,000 from Sanchez Electronics out over 6 years, that has less of a negative impact to my earnings per share, to my net profit of my company, which then is reflected in my stock price, right? So if I can go, I bought this chip for $1,000, I'm going to write off $166 over 6 years. Cool. But in reality, will that chip really last 6 years? And this is what you're going to be learning about this afternoon with me. This is called cheating the depreciation schedule. In reality, that $1,000 chip that Microsoft just bought from Sanchez Electronics, it may only last a year, but yet the company is depreciating it out over 6 years. Why are they doing that? Because again, as a company, you want to spread out that depreciation so you're not taking a big hit on your earnings. So if I wrote off that chip, because it's, so it's only good. Technology's changing. That chip's only good for the first year. Imagine the size of write-off that my company would, or Microsoft in this example, would take. Massive. I'm giving you a simple example. We're talking billions, hundreds of billions of dollars. All these different companies are spending on chips. So they write it off this year or in 1 year, big hit to the bottom line. Big hit to the bottom line means Wall Street's going to look at it and go, uh-oh, your expenses are out of whack. Let's sell off your stock. But if the company goes, I'm going to depreciate that over 6 years, less of a hit, not affecting the bottom line, stock does well. That, folks, is what we call depreciation schedule cheating. But we'll go into more details when we come back. It's a fascinating topic that, again, could impact your portfolio. Turn it over to Kristen Snow right now, Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on Newstalk 780 KOH. Happy Friday to all of you. All right, let's get down to the stock market, and then we're going to come back to our topic, cheating the depreciation schedule, and what's going on from an accounting standpoint, therefore an earnings standpoint, potentially with these AI companies. All right, hit the stock market side. Tough day all the way across the board. At least that's the way it was this morning. We were down worst level, just a smidgen, I think 580, 590, if I remember, negative. So almost a 600-point loss on the Dow at our worst level. We made our ways back. Fortunately, kind of hit a pocket of selling pressure going into the close. And we finished down 310 on the Dow, a 0.65% loss to 47,147. Nasdaq, though, a 30-point gain, closing at 22,900. S&P down 3, finishing the day at 6,734. Commodity-wise, strong day for oil, $1.34 rise, $60.08 a barrel, down $99.80 on gold at $4,095.70 an ounce. 4 basis point increase on the 10-year. Yield closed 415. For the week, the 10-year Treasury was up 6 basis points. Now, why were we down so much? Why did we come back a bit? Well, when we were really down towards the bottom of the barrel today on the Dow side of things, we had technology names, right? It's been a tough last couple of days for the members of the Dow because of technology, because of the Fed, and it was no different today. Early this morning, you had all your big names that were down, and then all of a sudden, just out of nowhere, like I always tell you, you just never know. Here comes the buyers, right? Stocks hit some cheap levels, according to the algorithms, et cetera. They started buying them. So we started to see the likes of Microsoft, NVIDIA, Oracle start making their way back. That propelled the Dow higher. But then again, going into the close, things began to weaken. And like I said, they sold it off. Had a lot of pressure in the healthcare area today. United Health was down $12.40, bottom of the Dow list. You had some financial stocks, this whole Jeffrey Epstein email release and all that crap that's going on in Washington. Trump midday today makes comments that he wants the DOJ to start investigating a bunch of people, including JP Morgan, where I guess Epstein had money. So literally, as soon as they said that, JP Morgan began to sell off. It finished the day down $5.09. Again, you just never know anymore. All it takes is a certain post and company can just, unravel. That's kind of the way it was today. But the good news, here's the bright side. Glad to see the buyers came back in some of the beaten up tech names of this week, right? So Micron today, here's just a few names. $9.88 gain, 4.17%, 246.83. NVIDIA rose $3.31, 190.17, about a 1.77% gain. Microsoft on the upside by $6.89 to 510.18, and Oracle rising $5.28 to 222.85. Energy sector, as I said, thanks to oil, one of the top performers. The group itself up 2.3% after yesterday's 4.1% slide. I shouldn't say the group, but oil prices. Let me kind of go down my list here, see what else really was a standout. Not too much. Let's talk the Fed. I told you yesterday on the show we had three Fed members make comments that were digested by investors that the Fed is in no hurry to raise interest, to cut interest rates come the December meeting. Two out of the three were voting members, so they carry a little bit more weight than the third person. But the bottom line, you had three Fed members yesterday in the roundabout way saying we're in no hurry to cut interest rates in December. Well, if that wasn't enough, here we come today. So let's see. I know we had Neil Kashkarian. He made some comments about that. Let's see. And he's a non-voting member. He said he did not support the October move, meaning the 0.25% cut, and he remains unsure about December. Then you had Kansas City Fed President Schmidt, who is a voting member, signaled he is inclined to oppose a December cut. So here's the game the Fed's doing right now. They're sending out all these FOMC members doing their lunch and dinner speeches, as I like to call it. And some of them are going to say, not favor of the December cut. You're going to get some probably next week that are saying, oh, I am in favor. So that the market is left guessing what's going on, what the Fed's going to do. Remember, we had Jerome Powell at his Fed meeting a few weeks ago, basically say, don't count on us cutting rates in December. And that's kind of when all the selling really started and kind of bringing us down to where we are now. So it's really simple to summarize what's going on in the market with your portfolio. It's valuations, like you're going to learn even more about when we come back from break, and it's guessing what the Fed is going to do in December. Now, the last thing I'll mention about the Fed is what's the probability right now that we are going to get a 0.25% rate cut in December? Well, just to give you a brief example, a week ago, the CME Fed Funds Fed Watch tool indicated there was a 94.4% probability a week ago that we're going to get a 0.25% cut. Yesterday, 50.1% chance. Today, 45.9%. So you see it's just continuing, obviously, to decline as far as the probability of a 0.25% cut. And a lot of that's attributed to what I just mentioned a moment ago, where you get all these Fed members coming out and talking the book up, basically, is what we call it, saying, we really don't want to do a Fed cut. So I think the Fed's going to have themselves one hell of a mess, to be honest with you. Sorry for my French. Come December, if they don't give this market a 0.25% cut to wrap up the year. I really do. So hopefully things will change. Still a long ways away, but we will see how it transpires. Okay, you're up to date on the market, on the Feds, the bonds, the commodities, etc. Now, when we come back, get a big cup of coffee. I'm going to take you into the world of cheating the depreciation schedule and what may be going on. I'm just going to say what may be going on. It is going on in the world of AI and accounting and the performance of their stocks. When we return, let's turn over to Jack Saban. He's got news, traffic, and weather. Jack, welcome back to the Jon Sanchez Show on News Talk 780 KOH. Happy Friday to all of you. Once again, we lost 310 on the Dow, up 30 on the NASDAQ, and a 3-point decline on the S&P 500. All right, I need to squeeze out a few more bits of energy out of all of you. I'm going to take you into the world of accounting and how it relates to those of you that may own some of the chip-related stocks out there, the AI-related stocks, the NVIDIAs of the world, etc. Or you're just an investor, which probably most of you are, I'm guessing. But before I do, and I get into this story about this, there's two things as I went through the first segment of the show, talking about how depreciation works and what's going on with the AI segment in regards to how quickly or how long they're depreciating their hundreds of billions of dollars of chips the industry is buying. This article I'm going to share with you here in a moment, and this is where I got the idea to talk about this, even though it'd been on my mind. I came across it last night. It was about 9 o'clock, and I found this article, and I'm like, oh my God, this is just so perfect for the show on Friday. This is somewhat of a story with a gentleman that some of you may know his name. You definitely have probably know the movie that was made about him. I'm talking about Michael Burry. Michael Burry. Now, Michael Burry was the gentleman that the movie The Big Short was created after. Now, If you don't have anything to do this weekend, find it. I don't know where it is. I'm going to look because I'm going to watch it again this weekend. It's been a few years. I always like to watch it a couple years. Michael Burry was the gentleman that called the housing crash in 2008, his hedge fund. He made a personal profit of $100 million from his correct prediction when he bet against the US subprime mortgage market. Total profit for his investors, more than $700 million. His hedge fund, Scion Capital, which he shut down in 2008 due to investor backlash and a desire for privacy, generated net returns of 489.34% between its inception in November of 2000 and when it closed at 2008. Again, this story by Michael Lewis, The Big Short, is all about this gentleman I'm going to tell you about and what he thinks is going on with depreciation with these AI companies. Okay, this article I'm going to share with you, it's going to serve you best if I just read through it. I'm going to stop and make some comments because it's a pretty long article, but it's just chock with information you need to know, and I just could not paraphrase it well enough to make sure you get all the points. So this is out of Forbes, by the way. Give them all the credit. All right. So the Big Short investor betting $1 billion against the AI bubble says Meta and Oracle's accounting is hiding the brutal truth. It'll happen slowly and then all at once. That's how Jim Morrow, founder and chief investment officer of Callodine Capital, describes the eventual, inevitable unwinding of what he calls the most crowded trade in history. Of course, he isn't just paraphrasing Ernest Hemingway. He's talking about the AI race and the trillion-dollar deals so overstretched they're better described as knots than trades. And he's not alone in sounding the alarms. Michael Burry, the investor of Big Short fame, who famously predicted the 2008 housing crisis, broke a 2-year silence this week to say nearly the same thing. The big tech AI era profits are built on one of the most common frauds in modern era, stretching the depreciation schedule. Some, including Burry, would say cheating the depreciation schedule. And it landed with extra weight. Early this week, Burry quietly deregistered. Now, this is this week, folks. This is all like very, very fresh information. Earlier this week, Burry quietly deregistered his investing firm, Scion's Asset Management, effectively stepping away from managing outside money or filing public disclosures. Some analysts interpreted the move as less of an ominous sign and more as a Bruno Schneller, managing director of Erling Capital Management, told CNBC, stepping away, quote, from a game he believes is fundamentally rigged. On to much better things, Burry hinted on X, with a new launch expected on November the 25th. Freed from the obligations of reporting and client management, Burry returned to X with a message that cut straight through the current AI euphoria. You see, to him, the boom in GPUs, data centers, and trillion-dollar AI bets isn't evidence of an unstoppable growth. It's evidence of a financial cycle that looks increasingly distorted, increasingly crowded, and increasingly fragile. Burry put the numbers to it. In a post on X, the investor estimated that big tech will understate depreciation by $176 billion between 2026 and 2028, leading their reported profits by 26.9% at Oracle, inflating profits by 20.8% at Meta, just to name two of his specific targets. I'm going to stop right there. I should tell you, Wall Street's trying to figure out, we think that he has shorted these names, meaning he wants them to go down. So you always got to keep that in mind when these hedge fund managers make these predictions. 9 times out of 10, it's what we call talking up their book. If they're talking negative, they're probably short. If they're talking positive, they're probably long. So everyone's trying to decipher, but now that he deregistered as of, I think yesterday it was, you can't get access to his SEC filings. Okay, so keep that in mind. Meta did not respond to a request for comment. Oracle declined to comment. He's spot on, Morrow tells Fortune. Morrow has been making the argument for months, warning that a tsunami of depreciation could quietly flatten big tech's AI profits. Behind the trillion-dollar boom in chips, data centers, and model training, he argues, lies a simple but powerful illusion. Companies have quietly changed the length of time they account for their machines and their semiconductor chips, wearing out and depreciating. Now I'm going to stop there. During the break, I went into the IRS regulations, and just as I said earlier, I just wanted to verify, because it's been a while since I've taken an accounting course. IRS allows companies to depreciate computers and peripheral equipment over a 5-year depreciation cycle or 5-year time period, all right? General manufacturing equipment falls between 5 to 7 years. So that's how long they allow you to depreciate it out. Okay. And then it gets a little more complicated. You get into the CHIPS Act, investment credit, blah, blah, blah. But anyways, just let you know on that. This is a quote from Mr. Morrow. Companies are very aware of it, Morrow claims. They've gone to great lengths to change their accounting and depreciation schedules to get ahead of it, to effectively avoid all the CapEx or capital expenditure hitting their income statements. So let's stop there. So again, when a company goes out, spends $1 billion on chips, that's a hit to their income statement. But again, instead of showing that $1 billion they spent now, they get to depreciate it out. The longer they depreciate it out, the less hit to the financial statement, like I told you in the first segment. Burry's post drew viral attention. Morrow's been making the case longer, but he thinks the sudden resonance means investors are finally waking up to something fundamental. Quote, these aren't small numbers. They're huge. And the fact that someone like Burry is calling it out tells you people are starting to notice what's happening between the lines of the balance sheet. Here's how depreciation works, or doesn't. When tech giants like Microsoft, Meta, Oracle build AI data centers, they buy tens of billions of dollars in GPUs, servers, and cooling systems. Now, normally those assets lose value fast, which cuts into profits. But recently, Burry claims many companies are quietly extending how long they claim those machines last, from roughly 3 years to as many as 6. Now, that simple change lets them spread out their cost and report fatter earnings now. Quote, had they not made those changes, Morrow says, their earnings would be dramatically lower. Of course, we all know if earnings are lower, stock prices generally go lower. Meta's filings, for one, seem to at least corroborate the directionality of Burrow and Morrow's claim. Until the year 2024, servers and network gear were depreciated over 4 to 5 years. Effective January 2025, Meta said they would, quote, extend the useful lives of certain servers and network assets to 5.5 years. Now you may think, okay, big deal. They're going to go from 5 years to 5.5. Folks, when we're talking billions of dollars hit to the bottom line or not, that's significant. Quote, depreciation expense on property and equipment, Meta wrote in its annual filing for 2022 was this is so good. Listen to this. Depreciation expense on property and equipment, Meta wrote in its annual filing for 2022 was $8.5 billion. 8.5 billion. In 2021, it was 7.56 billion, and in 2020, it was 6.39 billion, respectively. In other words, depreciation was a major cost already, and management clearly chose to stretch the timeline over which the costs are recognized. The policy change doesn't improve Burry's dollar total across firms, but it markedly moves reported earnings in the direction he describes by lowering near-term depreciation expense and pushing more of it into later years. Morrow argues that the timing makes little sense. As the pace of technological change accelerates, NVIDIA, now listen closely, this is one of the most important things I'm going to share with you. NVIDIA now releases new chips every 12 to 18 months instead of every 2 years, which means the hardware becomes obsolete faster, not slower. It's like any old technology. Take laptops. Imagine trying to run the newest version of Adobe Premiere Pro on a 2018 MacBook. Sure, it might boot up, but it's going to overheat, lag, or crash because it simply wasn't built for today's computer demands. Old chips are the same way. They don't stop working, but they quickly lose their economic value as newer, faster models render them functionality obsolete, Morrow argues. To be sure, Morrow's expertise is in the value investing in high dividend companies as opposed to the trendier, high growth tech stocks. In fact, he said he has no long positions in technology broadly. So he benefits if big tech multiples compress or if the markets begin to reprice the cost of that's buried in AI spending. Still, his critique aligns with growing unease from other analysts. Richard Jarek, an analyst at Uncovered Alpha, has raised similar alarms about the mismatch between AI chip lifecycle and corporate accounting. Now, I want to stop there before I go to break, and I want to just go back to something very important I said, because I'm covering a lot here, and I apologize for being a Friday doing this to you. So once again, NVIDIA now is producing these chips every 12 to 18 months, right? Before it used to be 2 years. Now, why are they doing that? A whole nother show. But the bottom line is, if I bought a chip from NVIDIA a year ago, and we're fast forward to, where we are today, that chip's just about obsolete. Does it run? Yes. But is it worth the same value as it was when I bought it? Absolutely not, because technology changes and it improves. So therefore, they should not be able to, a Meta, a Microsoft, they shouldn't be able to depreciate it out over 6 years. If that chip's no good and I've got to move on to the next new chip coming out of NVIDIA, I should take that full depreciation that first year, because the chip's now almost basically worthless to me. But again, that would be a major hit to my bottom line. So therefore, I depreciate that over 6 years, and their finances look stronger than what they should be, because there should be much more depreciation schedule. All right, or expense. All right, I'll continue on. Let's wrap it up with Kristen Snow right now, Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH. All right, we're talking once again about cheating the depreciation schedule. Again, very, very wonderful article in Fortune written about kind of the strategy of Michael Burry. Again, the guy who created the movie was about him, The Big Short, and then some other gentlemen in the industry that are all coming up with the same concern that some of our big tech companies that we all love may not be doing accounting properly when it comes to depreciating their chips. Once again, we kind of left off with NVIDIA's coming out with new chips every 12 to 18 months. But how can these companies depreciate the chips over 6 years? When those new chips come out, they got to get rid of the ones they just had. 12, 24-month cycle. So is this right accounting? So let's go back to the article. I left off with Richard Jark, an analyst at Undercover Alpha, has raised similar alarms about the mismatch between AI chip life cycles and corporate accounting. He has said that the latest generation of GPUs wears out faster than companies' amortization schedules suggest. While some point to the continued use of NVIDIA's H100 chips, released 3 years ago, as evidence of longer utility, Jark says that's misleading. Demand remains largely high because a handful of companies are subsidizing compute costs for end users. A dynamic, and this is reference to what I keep saying, circular accounting, a dynamic that depends upon investor cash flow rather than fundamentals, Jark argues. More importantly, NVIDIA has now shifted from releasing new chips every 18 to 24 months to now an annual cadence. In that context, Jark says treating GPUs as they'll remain valuable for 5 or 6 years is unrealistic. Their true economic life, he estimates, is closer to 1 or 2 years. The recent sell-off in mega-cap AI names, the team led by Vivek Arya wrote, was driven by correctable macro factors: shutdown jitters, weak job data, tariff confusions over misinterpreted OpenAI comments, rather than any real deterioration in AI demand. In fact, the firm pointed to surging segments like memory and optical, up 14% last week, as well as NVIDIA's disclosure of a $500 billion plus 2025-2026 order, as signs the underlying spending cycle remains robust. Now let's see. Every month, $35 billion stack of GPUs sits without power. That's $1 billion of depreciation just burning a hole in the balance sheet, this analyst said. So, of course, they're panicking and they're ordering their own turbines. So the article goes on to talk about that. You get the gist of it, right? There's always something going on, but I think this article makes us all begin to sit back and think about. Always do your research. Always do your homework before you get involved in different types of technology and things. Is it here to stay? Is it wonderful? Absolutely. We just don't want to get caught like we did in 2000, 2001, 99, that whole era where all of a sudden some accounting irregularity shows up and we're like, uh-oh. And that's what happened in 2008, which is a whole nother topic. All right, folks. Thanks so much for sticking with me this Friday afternoon. I wish each and every one of you a great weekend. We'll see you on Monday. God bless.